Hi, this is Francesco Nagari, Deloitte Global IFRS Insurance Lead Partner. Welcome to our November Insurance IFRS webcast. The title of today's webcast is "The Accounting for Indirect Participating Contracts Remains an Open Issue. Only a number of small decisions reached this month." As always, the webcast will be structured around three agenda items. I will start by giving you the highlights of the ISB meeting, which was held last week on the 18th of November, and then we'll spend most of the time to discuss what the analysis of the issues was according to the ISB staff, the discussion around those points, and the decisions that the ISB has reached. I will then spend a few minutes at the end to talk about the next steps. So let me start with the highlights. The first and perhaps the most important highlight for this month is that the ISB did not reach a view on the staff recommendation on the accounting for indirect participating contracts. The matter will be discussed again in a future meeting. It could be that December will be selected for that discussion, although there was a degree of discomfort among the ISB staff members when the chairman demanded the December meeting to be penciled for this second chance for debating this important issue. The decisions that were reached were few, in fact 5 of them. The first one is on the variable fee approach, or VFA, as is becoming more and more commonly known among the experts in the field. Will not be amended, and it will stay as it has been agreed in June, to include also financial guarantees embedded in an insurance contract in the accounting for the CSM, rather than being separated and be part of the underlying items. Equally, the general model, which was compared to the VFA throughout this quite extensive session on the 18th of November, will not be amended as far as the accretion rate that would be used on the CSM balance. And so the decision that the board reached several months ago has been confirmed even after this comparative session with the VFA, where the current discount rate is used for accretion but not for the general model. The general model will be again only using the locked-in discount rate that is determined at the point of sale of an insurance contract. The entity will also have permission under the new standard to measure at fair value through profit and loss a number of assets that are not necessarily permitted to be measured on that basis, and you see the list on the highlights. Some of those items actually are not assets in the first place, and they have been created as assets purely to eliminate an accounting mismatch for unit-linked contracts, which has now been extended, and that is the decision to all other forms of direct participation features. Another decision, which is quite important within the life insurance sector, is that there will be a simplified restatement approach to calculate the opening CSM balance for all contracts that are direct participating contracts, so contracts under the VFA, when the policy-by-policy restatement becomes impracticable. And this simplified approach is quite clear, and I believe that most of you will concur with me when I explain it to you, that is pragmatic and useful to get this opening CSM calculated when the full restatement is impracticable. Finally, the option to recognize changes in the value of the guarantee embedded in the insurance contract in profit or loss should be applied prospectively from the date of initial application of the standard. That again is a particular accounting decision that the ISB reached in the last couple of months that applies only to VFA, and they have now dealt with how that separation of the effect of embedded option guarantees from the unlocking adjustments should be done on transition, and that should be on a prospective basis. The discussion around the indirect participating contracts that I predicted would be tabled for this month was in the context of a much broader agenda paper that compared the general model or building blocks approach with the variable fee approach that the ISB decided to adopt for direct participating contracts at their meeting last June. In order to do that comparison in a way which was sufficiently comprehensive, the ISB staff laid out a number of matters, which I summarized in the next slide. The first one is to analyze the similarities and differences between the general measurement model and the VFA in order for the ISB to conclude whether they can be regarded as a single model or whether they are effectively two separate models. It's an important philosophical distinction which will have potentially a bearing on the decision not to re-expose the new IFRS for insurance contracts. The second matter is the confirmation that under the VFA, the changes in fulfillment cash flows caused by guarantees embedded in an insurance contract should be adjusted through the CSM before being recognized in profit and loss. And that is the key feature that makes the VFA different from the general measurement model. Also, the agreement on requiring or permitting the use of current discount rates on the remeasurement of the CSM in the general model, which was debated, and the accounting for indirect participating contracts, which the ISB staff handled by proposing to introduce a clarification of the general measurement model requirement for the unlocking adjustments of CSM when they include the effect of the insurer's discretion. And let me hold you on to that, and I will explain in a bit more detail what this entailed. The other matters that were considered were the three narrow issues arising from the variable fee approach. The first one was extending the ability to permit the fair value measurement through P&L of certain items. The second was the simplification of the restatement of the opening CSM on transition when it becomes impracticable to do a full restatement. And thirdly, how the option to recognize changes in the fulfillment cash flows caused by embedded guarantees and options in P&L, because they are part of a hedging relationship, should be done when the VFA contracts are restated on the first time adoption of the new standard. So let me start with the decision on financial guarantees embedded in insurance contracts, a confirmation here. And the staff recommended that the VFA should not be amended to include financial guarantees embedded in insurance contracts in the underlying items. In other words, they were effectively comparing the fact that under the VFA, but not under the general measurement model, when there is an impact that is caused by financial variables, like changes in interest rate, there is a principle for the general model that is all those changes will have to be reported in either profit and loss or the OCI if that is the choice that the insurer will have adopted for presentation of interest rate effect on the liability. That principle does not apply when you are accounting for that contract under the variable fee approach, and instead you take all the variables, both market and non-market variables, in terms of their impact on the future expected cash flows against the CSM. And so the recommendation was to stick to that and to keep it as it was decided in the last few months. One ISB member, which clearly did not support the VFA, observed that, in his opinion, all financial guarantees would be better presented in P&L or in OCI rather than in CSM. But other ISB members echoed the staff concerns that if this was the direction, the standard would create too much complexity, because the entity would need to measure the guarantees at each reporting date, and even the current book yield approach that the ISB adopted 2 months ago would become more complex to apply in practice. Not to mention that from a definition perspective, these guarantees are actually currently not well defined in the current text of the standard, and so that would require substantial effort. So many ISB members felt that given where they are, in other words, given they are completing the project as we speak, and the fact that there was a practical solution necessary to implement this body of regulations, they felt that all those considerations outweigh the possible cliff effects that would result from having the two models that the staff present, the VFA and general model. The board approved the staff, and only two members, the one that raised the concern plus another, voted against. So a very large majority of 12 against 2 on this first decision. The second decision was around the so-called remeasurement of the CSM using current discount rate. I said so-called because, as you can see, the SB discussion picked that word immediately as something that they prefer not to be used in the final text of the official decision, and suggested instead that the ISB update, which was released this week, talks about the rate for accretion and unlocking of the CSM being at current rates or at the locked-in rate. Having clarified the terminology, and of course the staff was not resisting that clarification, the ISB agreed with the staff analysis that for the general model, the CSM is a residual calculated at the point of sale that does not reflect the current value of the future cash flows in everything. In particular, it uses historical premiums and not the premium that the insurer would charge for the unexpired coverage at the reporting date. So because of that, they felt that there should be a different treatment. When you compare that with the calculation of the CSM for VFA contracts, in that instance, they observed the staff was right in pointing out that it does require the use of current values because the current values of the underlying assets are used to re-estimate the future variable fees, which are effectively the amounts that the insurer would retain by deducting from the gross return the underlying items would have generated the amount, the variable amount credited to the policyholder through the distribution mechanism. In addition, to accrete and adjust the CSM using current discount rates in the general model would result in recalculating the opening balance of CSM at each reporting period. And continuing on the next page, in the view of the staff and some ISB members, these catch-up adjustments for the general model would actually introduce complexity and would be also hard to explain to investors because they do not relate to future cash flows, they actually relate to past events. There was also a comment where somebody drew a parallel with the IFRS 15 standard on revenue, where there is no remeasurement of the gross margin that an entity would expect to make by selling a particular product to customers. Other ISB members consider that the unlocking and accreting at current rates is actually conceptually preferable. And they said, well, one reason is that these are long-term nature contracts, and a significant component of the CSM is actually the expected future investment margin. In their view, the use of locked-in rates would actually create a lot of burden, administrative burden, because you will have to retain a lot of historical data and create a liability balance which has to be measured in different ways depending on the component you are measuring. Fulfillment cash flows, on the balance sheet at least, will be always on current discount rates. Then you have the invisible balance sheet that creates the OCI, P&L, interest expense. But if you don't choose that, you haven't got that. And you still be forced to actually create a database of historical rates to accrete the various CSMs, balances that you will have accounted for across the different portfolios of contracts and over the different years in which those portfolios have been building up their in-force contracts. The other thing is that it's not clear, to counter that point, which current rate would be used. And as the two camps in the board debated the issue, the two alternatives that were debated were, on one side, the rate that is also used for the main balance sheet accounting, the discount rate for fulfillment cash flows, or something that would be more akin to the VFA rate, which is based on the underlying items, effectively. Having carried out all these extensive debates, the board came to the final conclusions by considering that unlocking current rates could be matched by the existing accounting policies, but when you actually try to do that, you realize that it may actually turn out to be more complex than one would have thought. And eventually, when the ISB staff also clarified that if you accrete interest on the CSM using different discount rates, you actually produce different liabilities on the balance sheet. That was eventually the argument that swayed a number of board members away from the current accretion rate camp, and when the vote was called, 10 board members voted in favor of the proposal from the staff to effectively prohibit the use of a current accretion rate for the general model, and to leave that requirement only in place for the variable fee approach. Four board members still continue to believe that a current discount rate could at least be permitted as an accounting policy choice in the accretion accounting for CSM, but as you can see, they were put in a relatively small minority. Let me now move on into perhaps the most important matter discussed last week, which is the treatment of discretion in participating contracts under the general model, which is the long-winded way the ISB staff used to refer to the accounting for indirect participating contracts. And the recommendation that they put forward is that the effect of discretion to be recognized in the CSM under the general model is the change in the expected discretionary cash flows other than that which offsets the effect of a change in market conditions. It's a fairly complex sentence, I acknowledge that. So let me go through the slide and explain where the staff is coming from and what they're trying to do with this proposal. So the first point to make here is that this recommendation relates to the issue of this famous large class of contracts called the indirect participating contracts. These are the ones that are excluded from the variable fee approach, even if their cash flows are asset dependent, and even if the insurer that sells them does look into its assets to determine how much should be credited to the account of the policyholder every year. So those are not fixed and guaranteed benefits. They are variable benefits, and they are asset dependent, and the ISB has always acknowledged that. However, the mechanics that the insurer would use to award policyholders with benefits which are effectively asset dependent does not take into account of a particularly clearly defined contractually based pool of underlying items, and so that makes these adjustments not one that will be taken into account when you unlock the CSM. So you unlock the CSM for the changes in the prospective level of asset-dependent cash flows payable to the policyholder, but as far as the shareholder is concerned, there is no impact of the assets going up or down, and therefore the bonuses to policyholders going up or down. On the contrary, the VFA changes in the CSM when the variable fees that the insurer expects to receive have changed following the changes in the clearly specified underlying items that the insurer will hold on its balance sheet would be adjusted, would be unlocked. But the absence of a clearly specified underlying items for indirect participating contracts would then lead to that type of adjustment being precluded to them. And so the expected variable fees from these contracts will be recognized in profit and loss as the underlying items would generate gains and losses on the P&L without adjusting the CSM. Now, if the insurer would have elect the accounting policy choice of splitting the effect of interest rate between P&L and OCI and apply that also on the assets, for example, under IFRS 9, then those changes will be through not only the P&L but also the OCI. Given that the asset dependency of the cash flow outflows and the resulting variability of fees are both caused by the contractual discretion that characterizes indirect participating contracts, the staff proposed to analyze that feature to identify a solution. And they noted that there should be 4 ways of viewing the contractual discretion. This is based on a simple example that pays a variable fee, which is based on a fixed rate bond, 5%, and the insurer decides to pay 4.5% to the insurer, to the policyholder. I'm sorry, and then at the same time, it has got an embedded option that guarantees a minimum return of 2% under all cases. And at the start of the policy, the market rate equals the rate of the assets, 5%, but then 1 moment later, the market rates drop to 1%. And so they then look at what happens. How do the insurer will account these variable cash flows when the discount rates and therefore the market rates have dropped substantially? And so four possible scenarios were discussed. The first one is that discretion could be seen as any changes of cash flows that the insurer would put by lowering the original expectation. So when the policy was sold, the expectation was that the market rate would be 5%. You give 4.5% to the policyholder. You keep 50 basis points for you. If the interest rates drop and you are lowering your level of crediting rate to the policyholder, that would be the way to look at discretion. The second way is discretion is the decision to award the return on the assets that the entity holds, less a margin, subject to a minimum guarantee. So something similar to what you would do when defining a variable fee approach contract, a direct participating contract. You have chosen the assets you're going to put in the pool. You have told the policyholder in the contract, or you are informing them because of a regulation. They know that the distributable surplus will come from those underlying items. They know that you're going to make up your discretion and keep something for yourself as a variable fee and give the rest to them. So that could be a way to look at this without having the specified, contractually specified pool of items. Another way is C, option C, which is the discretion is on any additional return that the insurer would be willing to pay above market conditions, less any margin, and subject to the minimum guarantee. So in that example, when the market interest rates drop below the initial interest rate of 5% and go up to 1%, if the insurer decides that given they've got an asset, they can still pay 5% for some time, they may want to pay 4.5% still for a couple of years. Those extra cash flows that will be accredited to the policyholder account on top of the guarantee, on top of the market rate, actually, on top of the 1% market rate, should be considered the discretionary component of the cash flows. And the last and final view would be to say there is a minimum guarantee of 2%. Anything that is paid or credited to the insurer to the policyholder above that guarantee will be effectively the discretionary cash flows. So let's have a look. What did the staff recommend? The staff recommended view C. So they said with this guidance, the staff believes that they will be able to maintain the insurance indirect participating contracts in the general model and effectively justify that recommendation to just introduce a clarification about the discretion. They will also avoid moving the definition into a variable fee approach situation, which was effectively option B, by reference instead to market return, market variables. Now, how does this recommendation works? How does it work? So let me explain with these 3 bullets how I believe it works. The idea is that you have the changes in market variables, you have your projected level of bonuses and crediting rates. Market rates will change, so you discount now at a different level. What do you do in terms of accounting for that change in the liability? So in this case, in the example was a drop from 5% to 1%, significant increase in the liability because of those bonuses being discounted at a lower rate. And the issue then is where do you put them? P&L, OCI on one side, CSM on the other side. Now, what the staff is suggesting here is that you split them. And if they are discretionary, they will go against the CSM. If they are not discretionary and they are just the result of a change in the market variable, you then take them out of the unlocking and you book them into the same place where the market variables will have caused an effect on your financial statements. That could be P&L or OCI or both. So P&L or both P&L and OCI. For example, you would then avoid what is called the burnout of the CSM, because if there are better than expected market conditions, for example, an increase of market interest rates, you would then project a higher level of returns by discounting, a lower level of liabilities by discounting them at a higher level, but those things will affect the CSM. Equally, you could have a blow up of the CSM because of the revision downwards of market interest rates, which is what the simple illustration in the agenda paper of the ISB staff has actually calculated in this simple example. The proposed solution would actually split these changes in expected cash flows to recognize in P&L and OCI the whole portion that matches the changes in market variables, and unlock the CSM only with the residual change, which would be effectively the amount deemed discretionary in the overall expected payout to policyholders. And now, the key is that this is a change, is a clarification, but the reality is that we are looking at effectively a new way of doing the unlocking. Again, the ISB staff is arguing that they are not changing the general model, they are not introducing anything different, but the reality is that there is now a requirement to actually break down these unlocking adjustments that until 3 months ago were all together. The clarification that the ISB reached during the September and October meeting, and further again in this recommendation, are now clearly indicating that in the general model there is a situation that creates something that needs to be effectively split into parts. One that is market related and another one that is not market related. In our view at Deloitte, and this is our view as a firm, this is an interpretation that doesn't acknowledge the fact that in reality those insurers that issue indirect participating contracts have got the same use of discretion. They just do it in a slightly different context in which there is no contractual statement to the customer as to what is the underlying pool of items. But the reality is that we have economically similar behaviors, similar also variable fees being earned as a result of that margin. The 50 basis points which the staff illustrates as a constant is in reality not a constant at all. It is actually managed in the same active way as it is in the participating direct participating contracts. So having said that, let me take you through the discussion that occurred around this recommendation. The first observation is that one board member suggested that the entity should state how it views its expected discretionary cash flows. This was a board member that actually was in agreement with the staff analysis, and he suggested that at the outset, the standard could require that the entity would need to specify the expected return as it would be derived from a particular mix of assets. Again, you see that the idea of accounting defined mix of assets is always present in this entire debate, but not strong enough to lead the ISB to a decision that would align the two types of participating contracts. This board member said that the actual returns on the expected mix of assets and to the extent that a different amount is paid would be representing the exercise of discretion. This would be a way to see in the eyes of this board member how the recommendation of the staff would be adopted. Other ISB members were actually in disagreement with the staff recommendation, and they all said they would prefer option B, the one that actually seems to be much similar to the VFA, on the basis that an insurer would typically exercise its discretion through the asset mix it holds. So having that capturing exercise on the point of sale and then using that information, which is effectively dynamically managed every day by the insurer, to become such an important piece of accounting data would appear to these ISB members not a faithful way of representing the economics of indirect participating contracts. However, viewing an insurer's promise of returns as based on the actual assets held would push indirect participating contracts into the VFA. That is true, but that's perhaps the real question that the ISB is trying to answer, despite the paper being written in perhaps in a different way. Some of the members that supported this view B, were also concerned that in the staff paper that I was referring to earlier, the example that is illustrated with these simple calculations showed a CSM balance positive, so an expected profit in the future, even when the contract was becoming onerous because of the market interest rates being below the guaranteed level. And they were concerned that with the degree of variable outcomes produced, this would be arbitrary. In particular, the longer duration assets, when interest rates were increasing, would result in the liability and the CSM increasing, but the insurer not being worse off or better off at all, because they may still be happy to earn the same level of margin, or perhaps they may have acquired variable rates assets in the first place. Given all these concerns, the board told the chairman that they didn't feel collectively ready. In fact, the majority said they were not ready to vote on this recommendation, although 6 board members, a minority, were expressing their statements of being in favor of the recommendation from the staff. The decision that the chairman took at the end was not to call for a vote on this matter, and instead to defer this to a future meeting. We'll see whether this is going to be in 3 weeks' time, in the December board meeting, or potentially in the January 2016 board meeting. That concludes the part where the board compared the general model to the model on the variable fee approach, and I want to take you through now the 3 issues that were consequential to the variable fee approach. The first one is the measurement exceptions for items underlying contracts with direct participating features. Very simple here. There's been already an exception for a number of these items where the previous draft of the standard permitted the fair value through P&L of those items, such as investment properties, associates, owner-occupied properties, own debt, own shares, and the staff recommended that the same exception to the IFRS general principles is given for all those underlying items that are part of the direct participating contracts pools of assets. And so after a very brief discussion, this was approved unanimously. So that decision was easy. The next one is perhaps out of the 3, the one that I feel is the most interesting, is the introduction of a new simplified retrospective transition approach for contracts that fall in the variable fee approach. So what the staff recommended here that at the date of transition, an entity would measure the contracts accounted for using the VFA in terms of their opening CSM once they have reached the level of impracticability in the restatement by fair valuing the entity share of the returns from the underlying items, and then deducting from that amount the current estimate of the remaining net costs of providing the contract adjusted to reflect any cost already incurred, so effectively using the hindsight, and less also any accumulated fee for services that have been provided in the prior periods prior to the restatement date, determined by comparing the remaining coverage period with the total coverage period for the contract. So effectively by apportioning the coverage, the total coverage into parts, and whatever is the part that is prior to the date is assumed to be earned, and the part that is yet to expire is supposed to be unearned. An entity would then restate the CSM in comparative periods by adjusting the CSM at the date of initial application, assuming the total fee for the contract had not changed since the beginning of the earliest period presented, other than for the allocation of the CSM over those prior periods, which is, as you know, based on the passage of time. So a fairly pragmatic approach that would eliminate a lot of work, because you can imagine that in a full restatement you need to effectively consider what was the level of the value, the current value of the underlying items in that particular period, in order to calculate what was the amortization or the earning of the CSM for the subsequent period. And indeed, one member raised some concerns about effective application, because he said, what if you need to take into account the bonuses and distributions that actually had occurred since the beginning of the earliest period? What do you do about that? The real declaration, the one that actually gets accreted in the guaranteed element of the contract. The other concern is whether it is appropriate that only the entity's share of returns from the underlying items should be a fair value rather than the whole fair value of the underlying items. And then thirdly, he raised the concern about the practical guidance the standard would include to explain how to estimate the CSM at initial recognition using these simplified assumptions about cash flows, discount rates, and risk adjustments. Now, with that being put on the table, the board agreed that the staff objective was sound, and so they approved it, but asked that the wording should be revisited to make reference to the fair value of all the underlying items, less the restated fulfillment cash flows. With that amendment, which has been put through, the board unanimously approved the staff recommendation. So here we go. Now we have another simplified restatement approach. We got one for the general measurement model and one which has now been tailored very pragmatically for the variable fee approach, both of which will apply beyond the point in which the standard says the entity will have identified impracticability of restatement and therefore will not be able to continue with the policy by policy restatement. The third and final consequential issue from the VFA is how the option to recognize changes in the fair value of guarantees in the profit and loss rather than CSM should be applied on transition. And this is to remind you the regime that the ISB approved in the last couple of months to accommodate the fact that a number of insurers may have entered into derivative instruments to hedge the volatility on the underlying items that will be changing the variable fee over time, given that the variable fee is dependent on financial variables that affects the value of the underlying items, so the shareholder share of those underlying items may be hedged. And the decision was that you would effectively strip out of the unlocking of the CSM adjustments the component of fulfillment cash flow measurement that relates to those embedded option and guarantees, and book that through P&L against which you have the fair value gains and losses on those derivatives. Now the question then here is, what do you do on transition? And the recommendation from the staff is that you should apply the option to take this component of the fulfillment cash flows out of the CSM unlocking into P&L prospectively from the date of initial application of the standard. That is not the transition date, is effectively the effective date of the standard. So if we take the last estimate, it would be the 1st of January 2020, whilst transition date will be the 1st of January 2019, if you are looking at a 2-year comparative set of financial statements. One member in the discussion stated that it would be better if the option should be applied from the beginning of the comparative period, so from the 1st of January 2019, if I use these dates that I was just quoting earlier, because this would be helping comparability. And he felt that there was actually not such a great risk of hindsight in effectively setting these prospective views from that date onwards. But other members actually expressed a concern about that, because one in particular observed that insurers would know what the outcome was. These would influence their decisions on whether to apply the option or not. Another member also stated that in order to avoid cherry picking, an insurer would have to be required to act as if it had adopted the new standard before it was actually adopted, which would be hard to justify, particularly in light of the decisions that the board has made in respect of IFRS 9. So after all that, 13 members of the ISB approved the staff recommendation, and only one was against it. That concludes my account on the discussion and decisions that the board reached last week. Just a couple of minutes now on the next steps. Obviously, the ISB now has got a plan to reconsider the treatment of discretionary changes under the general model, which is the core issue around the accounting for indirect participating contracts. And that will be done either in December or in January. The issue on unit of account that was anticipated to be discussed this month by Deloitte appears to have been absent from the debate, certainly this month. And at this stage, we have to confess that it appears to have been taken out altogether from the residual agenda items. But we'll see whether these actually will be brought back into the discussion, given that there are many constituents who have been asking for that matter to be clarified. And so it is certainly one that Deloitte would strongly encourage the ASB to debate one more time, so they can tell us what is the various piecemeal of decisions that they've reached on unit of account over the last 20 months, I have to say, because right now there is ambiguity, it's fair to say. Now, having said that, the staff expects to prepare also the ballot paper, which is where they're going to explain to the SB the due process steps which have been undertaken in developing the standard, and then demand whether the ISB is happy not to re-expose again and to move straight into the publication of the standard. This paper is expected to be tabled in January. At that point, we may also have a decision on the mandatory effective date. That is the last decision, which is dependent on the publication date, and once you have the permission to ballot, then you should work out pretty quickly what is the time you may need as the ISB staff to draft the final text of the standard. And so it is plausible that this decision may be taken at the same time as the vote on the balloting of the final IFRS in the January 2016 meeting. That is my last point, and as I take you to the final slide of today's webcast, I would like to invite my team to stop the recording and open the floor for any questions you may have.